Good afternoon, everyone. Thank you for joining us today in our August edition of our monthly benefits webinar. We call this our lunch break webinar series. I'll be talking to you today about the Secure Act 2.0, the proposed legislation out there regarding retirement plans. My name is Jeff Gray. I'm a member here at Miller Johnson's Employee Benefits Practice Group. First, a little housekeeping. We have on this slide our upcoming webinar lunch breaks. So maybe make a note of those dates. We usually announce the topics ahead of time, but we can always use some input from you as well on what we should talk about. So there's a link here to our survey. And I think there you can also give us some indication about what you might like to hear us talk about in future webinars. So today, again, we'll talk about what we're referring to as Secure Act 2.0. Before I jump into that, though, what about Secure Act 1.0? Where does that stand? Of course, that was passed in 2019, and we finally this year had reached what was the deadline to amend our plans for compliance with the initial Secure Act. But just, I think in June, the IRS released a notice extending that deadline. So we have some relief on the time in which we have to amend for compliance with the initial Secure Act. So, the Secure Act 1.0 isn't even buttoned up yet. And now we're already talking about tinkering with it and making some other changes to the provisions that were in that original Secure Act. But anyway, we were planning by the end of the year to amend our plans for compliance with these changes to required minimum distributions, qualified birth and adoption withdrawals, the eligibility for long-term part-time employees, all those sorts of things that were covered by the initial Secure Act. The deadline for that now is December 31, 2025 for most private sector plans, and that doesn't depend on your plan year or your tax year. It's just the deadline is the deadline. I think selfishly, right, the IRS pushed that deadline back because we're lacking guidance on a number of those topics under the original Secure Act, including how to determine those post-death required minimum distributions, among other things. So keep that in mind. In any event, what about Secure Act 2.0? When we say that, what are we referring to? It's really a collection of three separate bills. We have a House bill called the Securing a Strong Retirement Act of 2022. That was passed in April with broad bipartisan support. I think it was 414 to 5 or something. That's really the House version of Secure Act, Secure 2.0. But then there are a couple Senate bills that are also in the works that are just being put out there by two different Senate committees. We have this Enhancing American Retirement Now Act, the EARN Act, and then this Rise and Shine Act. So those two Senate bills will need to be reconciled kind of within the Senate. And then, if the Senate has its version of Secure 2.0 and we have the House version of Secure 2.0, those two versions will then need to be reconciled to the point where we have a kind of sort of final package of legislation. And at that point, we'll know what the final Secure 2.0 is. We're kind of cautious. I don't know if optimistic is the right word, but we're sort of expecting this to happen this year. But it may not. But there, like I said, there's strong support on both sides of the aisle to get another major piece of retirement plan legislation done and done this year. So when I talk about Secure 2.0, I'm really talking about those three different sets of bills. They're not identical. There's different provisions in the different bills. But like I said, at some point they'll be reconciled and we'll have one version. But for just ease of reference and to prevent even extra sort of confusion, I'll just refer to Secure 2.0 in general going forward. So I think one of the biggest changes would be mandatory automatic enrollment for new plans. So if you have a new 401k plan or a new 403b plan for plan years beginning on or after January 1, 2024, they would have to include an automatic enrollment feature. Now, there are some exceptions I'll talk about in a second, but generally, general rule, got a new plan, you would have to have automatic enrollment with a default rate, default auto enrollment rate between 3% and 10%. You can go as low as 3, you cannot go above 10. And then you have automatic escalation of 1% per year, up to 10%. But there's some exceptions. Existing plans are grandfathered. So if you have an existing 401k or 403b plan, you really don't have to worry about this. And that's probably most of you listening in today. So that may be a relief. So existing plans are basically grandfathered. New plans established by new businesses that have only been in existence for, I think, 3 years are also excluded. Small employers with 10 employees or less are excluded. And then government and church employers would also be excluded from this automatic enrollment requirement. Another, I think, key feature of Secure 2.0 is the change that would be made to these protections for part-time employees that were implemented under the initial Secure Act back in 2019. We really, under 401k plans, were not permitted to outright exclude part-time employees. What typically you have is a provision, if you want to exclude part-time employees, is you just have a provision that says, they're eligible if they provide 1,000 hours of service in a 12-month period, and that's kind of like the minimum standard for eligibility. And if you have part-time employees who don't work that much, just as a practical matter, they never enter the plan. And so the Secure Act back in 2019 changed that and added a new rule where if these employees work at least 500 hours in 3 consecutive years, or they satisfy that general 1,000-hour requirement that we've always had, then they have to be permitted to participate in the plan, meaning they have to at least be allowed to make elective deferrals, although you could exclude them from employer contributions. And they also get credit for vesting based on that same criteria. Originally, so under the Secure Act, it was limited. This new provision was limited to 401k plans. And it became effective in 2021, which meant that we have to start counting hours in 2021. And conceivably, then someone might meet this new lowered standard and enter the plan as of 2024. And so this is that's all background. That's all background for 2019 for the initial Secure Act. But this would be changed under what we're calling Secure 2.0. The major change is that it would reduce that measurement period from 3 consecutive years to 2 years. So you'd be looking at part-time employees and whether or not they provide at least 500 hours of service over 2 consecutive years. Interestingly, this latest legislation, proposed legislation, I have to keep saying that just in case it's easy to fall into the habit of acting like this is the current rule, but again, these are all proposed rules. But again, as proposed, this new rule would also apply to 403b plans. 403b plans have a separate universal availability rule that has always allowed us to exclude employees reasonably expected to work less than 20 hours per week. And so I think this new rule expansion of part-time protections to 403b plans could be a pretty significant change. But the other, I think, notable part about this is that it's effective for plan years beginning after December 31, 2022, which is just around the corner, right? That's the beginning of next year. And when you look at the proposed legislation, we're counting these 12-month periods or service in these 12-month periods after January 1, 2021. So somebody could meet that 500 hours requirement in 2021, 2022, and basically become eligible January 1, 2023. So we'll see how this kind of shakes out in the final version, but it appears that by kind of expanding these protections to part-time employees, we might have them joining the plans sooner than we expect. Another change is just an increase, proposed change is an increase to the cash out limit. Currently, the cash out limit's $5,000. If you have somebody who separates employment and your plan allows it and their account balance is 5,000 or less, but above 1,000, you could roll it over to an IRA, or if it's 1,000 or less, you pay it out in a lump sum. This would just increase that cap to $7,000, so you can sweep more of those small balance accounts out of the plan. Another important change would be this increase in catch-up contributions. So beginning in 2023, the House version of this set of bills would increase the catch-up contributions for participants within a particular age bracket. So it's basically age 62 to 64, and it would increase the amount to $10,000, which would be adjusted, periodically for inflation. The catch-up limit would stay the same for ages 50 to 61 and 65 and older. It's really just, for whatever reason, they have a bump there for people between 62 and age 64 up to $10,000. And there's another related change to catch-up contributions. I'll talk about it in a second. The same concept, the same increase would apply under the EARN Act, again, which is a Senate version, but it's different ages. It would apply to ages 60 to 63. So that would be one more, I guess, complication here to track. But what's interesting is that these catch-up contributions under Secure 2.0 would also have to be treated as Roth contributions. So we've got this increase. We're allowing participants to make higher contributions, but the government wants those contributions to be taxed earlier. So they'll be taxed as Roth contributions. And it's not just the increase, not just the $10,000, not just that additional amount, but under this legislation, any catch-up contributions would have to be treated as Roth contributions. Similarly, the legislation would allow, but not necessarily require, matching contributions to be treated as Roth contributions. So currently those matching contributions go in pre-tax. This proposed legislation would allow the employer to choose whether they're pre-tax or Roth. Another kind of key feature is the ability to treat student loan repayments as elective deferrals under a plan, under a 401k or 403b plan. We had a private letter ruling from the IRS maybe in 2018, I think, where Abbott Labs had asked the IRS to approve a structure under which it was making basically non-elective contributions to participants who were making student loan repayments. So if they were making student loan repayments as of a certain amount of their salary, the company was kicking in a non-elective contribution of a certain percentage. It was a little bit of a kind of convoluted plan design, I think partly because there was maybe some concern about getting it approved. But I think it struck people, including people in Congress and experts, as generally a good idea, given the student loan burden that's on so many of an employer's new hire population and employees who have been around for a long time, frankly. So what this legislation would do is just make it a little cleaner and would allow the employer to treat those student loan repayments as elective deferrals for purposes of employer contributions, including matching contributions. The way it would sort of work is you have a elective deferral limit, right? It's $20,500 this year. What you could basically count your student loan repayments towards that limit and receive matching contributions on those student loan repayments. Not all participants have student loans, so there's the possibility that you might end up with a kind of skewed group of employees who have student loans or maybe highly compensated. So part of the legislation allows you to treat this group separately for purposes of non-discrimination testing, so you don't run into a testing problem by virtue of offering this. It would be limited to what the legislation refers to as qualified student loan repayments. And qualified basically means a debt incurred to pay for the cost of attendance at a higher education institution, which is defined under a separate statute, but it's like the stuff you normally think about: tuition, room and board. I think transportation's included. It's the kind of standard what you think of in terms of the costs for higher education. And so there'd have to, the tricky part, I think, if an employer was to add this, it would just be the administration of, having students explain how and prove how much they're paying in terms of student loan repayments and all that goes along with that. Of course, none of that's spelled out in the legislation, but I know that some employers have offered similar kind of post-tax benefits along these lines. So I think there are some record keepers out there who have a system for tracking this sort of thing. There are also changes to the required beginning dates. So we just had the change under the Secure Act that moved the required beginning date for most, for employees from age 70 and a half to age 72. So that change was just made a few years ago, and now there's more of a desire to tinker even more with that age. Under the House legislation, it would be kind of an incremental increase. So it would go up to age 73 in 2023, age 74 in 2030, and age 75 in 2033. I always get a little bit confused about how that timing works, but it's basically if you turn age 72 after the end of 2022, or you would turn age 73 before January 1 of 2030, then your required beginning date age would be age 73. Kind of works the same way with this jump from 73 to 74. So if you turn age 73 after December 31 of 2029, or you turn age 74 before January 1 of 2033, then your RMD age would be age 74. And then basically if you turn age 74 after December 31 of 2032, your RMD age would be age 75. But the EARN Act is a little simpler version where it's just bumping that age to age 75 beginning in 2032. There's also a nice related change that's included, which would reduce the excise tax for failing to take RMDs. There's really a punitive 50% excise tax on the employee for failing to take timely required minimum distributions. That's the current law. Because it's so punitive, the IRS is usually pretty lenient about giving participants a break on that if they have a good reason. And there's a kind of a process for doing that, where you send in a form to the IRS and you kind of explain what happened. And usually you can avoid that 50% excise tax. Hopefully that process still stays in place, but under this proposed legislation, that excise tax would get reduced basically in half, from 50% to 25%, which would be a good thing. There's not a ton of, I think, good news in this legislation in terms of improving employer obligations or making things simpler for employers. We're always looking for that. We're always trying to avoid compliance errors. There are some provisions that I think will be helpful. So number one, we think about, I spend a fair amount of time on the phone with clients about hardship requests. It's like you get a participant who wants a hardship and they've got some damage to their house, and you've got to figure out, well, was it due to a casualty loss where it'd be covered by insurance, that type of an unexpected loss, or was it wear and tear? We've got employers asking about the documentation that they should keep, whether an event, meets the standard for a hardship event under the plan or not. What this proposed legislation would do is allow the employer to basically rely on self-certification from the participant that the participant has experienced a hardship event. I think that would dramatically reduce the amount of administrative effort required around hardships. And I think the idea was, we went through the CARES Act, we had coronavirus related distributions that were allowed based on self-certification. And I think everybody thought that went fairly smoothly. So the idea is to extend that to the hardship rules, which I think would be good. There's also a new ADP safe harbor option for auto enrollment plans. So, right now we have rules for QACA plans or qualified automatic contribution arrangements that basically work at the lower end of, I'd say, the deferral rates, right? They kind of start at 3%. The employer makes some matching contributions up to 6%. After the participants automatically enrolled. Basically, this option would bump those limits up quite a bit, where you're auto enrolling somebody in at least 6% of their compensation, increasing it 1% per year up to 10%. And then the matching contribution, as you can see on the slide, is based on those higher amounts. So whereas the kind of current version of this, you're not making matching contributions above 6%. Here, you're making matching contributions all the way up to the full 10%. So I think that'd be a good option to be available. In terms of some other compliance relief, there are some references in the legislation to the employee plans compliance resolution system. That's, we just refer that to as the correction program. The correction program that the IRS has for correcting errors. There are some options that are in there already that are kind of baked into this legislation, I think, just to make them clearer, that an employer or a plan sponsor can have some minor errors and not really have a disqualifying event for their plan. But one of the things that just is explicit in this legislation is, if there's a kind of inadvertent benefit overpayment, the employer doesn't have to worry about the tax qualification of his plan. Currently, the EPCR's correction, the general rule is to go ask for that to be repaid, and then to make the overpayment, have the employer or someone else make the overpayment to the extent it's not recovered from the participant. This proposed legislation would basically, it would say that there's no penalty even if you can't kind of collect that from the participant. So less concern over small inadvertent overpayments. What I think is good too is that in this legislation, there's a direction from Congress to the Department of Labor and the IRS and the PBGC saying, hey, you all have to get together and give us a report that tells us what you think should happen to ease the reporting and disclosure obligations for these employers and for these plans. Anybody who works in this space, you just get a dizzying array of seemingly contradictory and inconsistent disclosure and reporting obligations that come from the Department of Labor or the IRS. And President Trump had an executive order that basically said the same thing, but it seemed like the agencies just ignored it. Nothing ever came of it. But this proposed legislation would include a direction to these agencies to take that extra step, which would be a good thing. As I mentioned before, reduced excise tax for RMD violations down to 25%. There's also a general description in the proposed legislation that would direct the IRS to expand that correction program and expand the types of errors that can be corrected through that program, which would also be good. And there's a provision that would establish a new national online searchable lost and found database. The idea with this would be to make it easier for participants who have separated from employment and maybe have lost track of where they might have a benefit. They could go to this online database and search to find out if they're owed a benefit. This would come with some reporting obligations by the employer, including an obligation to report any of those mandatory cash out distributions I was talking about earlier. If you have a mandatory distribution, it would have to be reported, and then it would go on this online database, and presumably a participant could then find it. So I think it's a good idea, but we'll see if it ends up in the final version of the bill, of the act. So those I think are the main and the most important topics. There were a few other provisions that I thought were worth mentioning. that are under either one or more of these three bills. You can see that there's some access to $1,000 penalty-free withdrawals for just a general family emergency expenses. So it wouldn't have to meet the hardship requirements, but just you've got a general financial emergency, you need to access the funds. They'd allow small withdrawals for that. Penalty withdrawals for victims of domestic abuse, penalty-free withdrawals, for victims of domestic abuse. There's a provision that just really clarified something under the prior Secure Act, which is that if you take a withdrawal for a birth or adoption of a new child, you can treat that as a rollover contribution if it's repaid within 3 years. And that 3 years is a new limitation. I think that was part of the confusion under the first Secure Act. I don't believe that there was kind of a deadline within which you were able to do that. So they would just, those withdrawals would just sort of hang out there indefinitely. So this just clarifies that issue. Again, like I mentioned, there's direction of the IRS to expand the errors that can be corrected. There's also a provision that would allow employers to give like a small gift card or some other small incentive to be provided to employees to incentivize them to participate in the retirement plan. And then let's see, there are a couple of provisions finally related to 403B plans that I think are important as well. 403B plans historically have only been able to invest in basically mutual funds. They've not been able to invest in collective investment trusts, which can be lower cost, especially for larger, they're sort of attractive for especially larger plans. And so a provision under these bills would allow 403B plans to expand those investment options over to different types, including collective investment trusts. And then finally, there's a provision that would allow 403B plans to participate in pooled employer plans or multiple employer plans that just wasn't covered under the prior Secure Act. So that is a quick rundown in about 25 minutes of what's in the Secure 2.0 proposed legislation. We try to keep these webinars to about half an hour, so I'm right on time. I'm looking at the Q&A here and I don't see anything. So I'll give it like another 20 seconds here maybe. And if anything pops up, I can answer a quick question. I have a question here about does the change in eligibility also change vesting? I think the answer to that, in terms of for part-time employees and the 500 hours in 2 consecutive years, I think the answer to that is yes. That same rule also applies to vesting, is my understanding. And I think I'm not seeing anything else come through. If you asked a question and I didn't give you a direct answer, though, feel free to just give me a ring and I can answer that on the phone anytime. So I'm not seeing any other questions, and I appreciate it. Thanks for spending some time with me today, and have a great day.